So the next stop on our journey in alternative assets is private debt. Now these differ from private mortgages and the security involved, so we're going to go through those details. Private debt can be defined as privately negotiated loans that occur outside of traditional banking mandates. So for an example, this would be a direct loan from an investor to a debtor rather than going through an intermediary such as a bank or a traditional network. But there are many advantages to doing so, and there are different types. Some of these advantages include strong historical performance relative to traditional fixed income securities such as bonds, debentures, and GICs. And more often than not, because of the nature of these loans, they have a lot more solid focus on preservation of capital. They often have lower leverage ratios when compared to traditional liquid securities such as bonds, which allows the investor to have better security on the actual assets. And because these loans are generally offered to maybe it's companies that have lower credit rating or perhaps more complex needs, they usually have an exposure to inefficient markets, which usually give a much higher return, although still with the same or even better protection for the investor. And once again, like most alternative assets, private loans are not marked to market. Much like their contemporaries, bonds and traditional fixed income securities that are going to fluctuate with the market, private loans generally just sail right along with very, very consistent return for the investor. And again, the common theme is usually there is an illiquidity premium that can be obtained for investors that do not need immediate liquidity from public markets. Therefore, these loans, because of that, are going to pay a higher yield in comparison to those liquid counterparts. So now let's talk about the different types of private debt. The first one is factoring. So what factoring is it's taking debt or its security from accounts receivable or other assets that are managed from businesses that are not tied to hard property. However, more often than not, there is still an inclusion of additional security such as buildings, equipment, other account receivables or cash in the form of almost a promissory standpoint, so that if there was a default on the debt, that the investor would be made whole. So why would a company want to do this? What it allows them to do is it improves their cash flow so that they can expand their business in light of the additional capital. So what happens is by obtaining this debt, they are quite possibly able to enhance their manufacturing or their deliverables, or perhaps fulfill a large order without going through the process of long-term bank financing and those types of covenants, which can take several months to do the due diligence. They can reach out to these factoring loans and loan providers and obtain the capital quicker and enhance, allowing the investor that liquidity premium and that higher interest rate. So the second category would be asset-based lending. Now this is more common and easier to understand because it's usually tied to buildings, property, it could be machinery, it could be direct covenants against inventories or supplies and parts that a company would have that it would distribute either to its customers or to its retail network. So that's a more simpler way to understand, and those would be very similar to a traditional mortgage. It's just that the backing is going to be different alternative assets versus an actual real estate or residential property. The third type would be more specialty lending. So these may be loans that are offered to a particular borrower with collateral of another pool of loans. This could be auto finance, point of sale receivables, different things within the consumer finance space. This area is one of the fastest growing areas in private debt just because of the changing nature of the consumer and the vast desire for these types of financing structures. So a great example of a well-run and diversified private debt fund would be that from NEXTEDGE Capital. We've been investing with NEXTEDGE for several years, and we've witnessed the exact advantages that I've stipulated here today. So for an example, while the rest of the market has been on this roller coaster over the last several months, in 2020, and this dates back to the end of April, they performed 2.11% positive with a consistent return of about 50 basis points per month without any negative pressure on their net asset value which is amazing compared to what traditional retail investors have went through in public markets. Now, this doesn't necessarily make it better or worse. It just means that by adding private debt in the proper proponent and with the right diversification, you can properly create the best non-correlated portfolio and drive returns and provide a smoother experience as an investor without sacrificing returns. Because remember, a lot of these loans are going to produce 8, 9, 10% yield on a consistent basis because of the characteristics and the advantages I outlined before. So once again, you have to have private debt as a main component of a properly diversified portfolio, just similar to the Canada Pension Plan, the Ontario Teachers Pension Plan, Yale Foundation, OMERS, and all these large institutional successful investors, because they are reaping the rewards of having this type of investment philosophy.